Welcome to Vold Revolution channel. We're going to deep dive the Boglehead's Guide to Investing, a bestseller book on Amazon.
And it really is a bestseller for a reason. I mean, that guide, written by Mel Lindauer, Taylor Larimore, and Michael LeBouf, it just cuts through so much of the noise.
The confusion, yeah, the complexity that Wall Street, kind of thrives on.
Exactly. It boils it all down to this common sense approach. And I think that's our mission for this deep dive, really. Give you a shortcut to those essentials of successful investing.
And a key part of that, which they stress right away, is focusing on your after-tax return. Not just the headline number, but what you actually get to keep while, taking on the least amount of risk.
That's the whole game right there.
It really is. And it all stems from this Boglehead community culture. It's built on rationality, a real intolerance of illogic, as they put it.
I love that phrase.
Me too. It's about facts over hype every single time. Their mentor, the founder of Vanguard, John Bogle, he just summed it up perfectly. He said the core belief is in the majesty of simplicity in an empire of parsimony.
An empire of parsimony. Parsimony meaning extreme frugality, which is key. Because the authors point out something that feels wrong at first. It's that investing is so different from most of life.
Right. All the rules you use everywhere else just don't apply.
Not only do they not apply, they can actively hurt you. Things like, if you don't know how to do something, hire an expert. Or you get what you pay for. The Bogleheads argue that following that common sense is, and I'm quoting here, destined to leave you poorer.
That is a stunning statement. I mean, right out of the gate, we're being told that the very instincts that help us in our careers or relationships will sabotage us with our money.
It's a process of unlearning.
It has to be. So for this deep dive, that's what we're going to do. We're going to focus on the things that actually work. Building that solid financial foundation, adopting the core principles, really getting asset allocation right, and of course, minimizing those costs.
And maybe the hardest part, controlling our own behavior.
That's the big one.
So before the book even whispers the word stocks, it just hammers home the need for a fundamental shift in your financial lifestyle. And they kick it off with this really sobering statistic.
That's a tough one to hear.
It is. Despite living in, arguably the richest country in world history, only about 5% of people actually achieve financial independence by age 65.
Only 5%.
And the difference, the thing that separates that 5% from the other 95, it's not their salary. It's not how much they make. It's what they do with the money that comes through their hands.
And the authors have a great way of breaking this down. They talk about 3 distinct financial lifestyles, and these really kind of set your path, don't they?
They absolutely determine your trajectory. So let's start at the bottom with what they call the borrowers.
The borrowers.
Their entire philosophy is live for today, forget tomorrow. And on the surface, they might look successful. They've got the new car, the big house.
But it's all built on a mountain of debt.
A mountain of bad debt. We're talking huge credit card balances, variable rate mortgages where the principal never seems to go down, massive car loans. The authors use this great phrase for it. Big hat, no cattle.
All show, no substance.
Precisely. They are robbing their future selves to pay for today's lifestyle. And the second a crisis hits, a job loss, a medical emergency, that whole fragile structure just implodes. Bankruptcy, foreclosure. It's disaster waiting to happen.
Okay, so that's the worst case scenario. But then you move up a step to the second group, the consumers. And this group has to be massive.
It's huge. And these people aren't necessarily drowning in credit card debt, but they operate with what the book calls a paycheck mentality.
Meaning everything that comes in goes right back out.
Every single month. They spend right up to the limit of their net income. The big question for them isn't, do we really need this? It's just, can we afford the monthly payments?
And that's such a dangerous question.
It's a trap. Because the consumers are so busy affording all the immediate, life necessities, the streaming services, the latest phone, the upgraded car lease, that they miss the actual opportunities to build wealth.
Like the 401k match at work.
Which is literally free money. They'll pass on that. Or they won't fund a Roth IRA because they feel like they have too many other bills they're just earning to spend. They might avoid bankruptcy, but they're always one step away from financial trouble. And they often hit retirement with almost nothing saved.
So the goal then is to become the third type, the keepers.
That's the goal. And for this group, the entire focus shifts. They're obsessed with net worth, not net income.
A huge distinction.
It's everything. They make a commitment to save and invest a minimum of 10% of their take-home pay first. It comes out automatically. Pay yourself first.
Before the bills, before the coffee, before anything else.
Right. They might earn less than some flashy borrower, but they're playing the long game. They max out their tax-advantaged accounts, and by doing that consistently over decades, they end up with far more money than they'll ever need.
So the book really stresses that becoming a keeper, it's a prerequisite. You have to do this before you even start picking investments.
Yes, and it involves 3 very specific steps. A financial foundation.
And step 1 is maybe the most important, especially today. You have to graduate to the net worth mentality.
You have to stop confusing a big paycheck with being wealthy. They're not the same thing.
Not at all. I mean, you could be a CEO making $1 million a year, but if you spend it all and have $500,000 in debt on cars and boats, your net worth is basically zero.
Or less than zero. Wealth is only, and I mean only, measured by your net worth. That's your assets minus your debts. Simple as that.
And you have to track it.
You absolutely have to track it. The book gives some hard data on this. Back in 2010, the median net worth for a family headed by a college graduate was about $195,000.
Okay.
Now compare that to a family headed by a high school graduate. Their median net worth was just $56,700.
Wow.
Now, education helps, obviously,
Mm-hmm.
but the real difference there is the mentality. It's the choice to save and invest that money instead of just spending it. The book says you have to calculate your net worth every single year. Treat it like a vital sign for your financial health.
All right, so that's step 1, change your mindset. Step 2 is more immediate, more action-oriented, pay off high-interest debts.
And they are laser focused on credit cards here. The math they lay out is,
Yep.
It's just genuinely shocking. It should be required reading for anyone with a credit card.
Lay it on us.
Okay, so imagine you have an $8,000 balance on a card. The interest rate is, let's say, 18.9%, which is pretty common.
Unfortunately, yes.
If you only make the minimum payments on that card, it will take you about 8 years to pay it off. And in that time, you will have paid over $7,000 in interest charges alone.
So you spent $15,000.
For $8,000 worth of stuff. You paid the bank almost double. It's financial insanity.
And the insight here is that when you pay off that 18.9% debt, you are getting a guaranteed risk-free return on your money of 18.9%.
That's it. There is no investment in the stock market, nowhere, that can promise you that.
Yeah.
It is the single best and safest investment you can possibly make.
So the advice is just stop. Cut up the cards if you have to.
Switch to cash or debit. You have to stop paying banks for the privilege of consuming. Which brings us to the final piece of the foundation. Step 3. You must have an emergency fund.
A non-negotiable cash cushion.
Absolutely. And this has to be boring money. We are not investing this for growth.
No, this is not the place to take risks.
Zero risk. It needs to be in a high-yield savings account, a credit union, a money market fund, somewhere safe and totally liquid.
Because its only job is to be insurance.
That's its only job. It's there to prevent a crisis, losing your job, a medical bill, a major home repair, from forcing you to sell your long-term investment.
Which is the worst possible thing you can do.
It's catastrophic because those crises, they always seem to happen when the market is already down. So you're forced to sell at the bottom, locking in huge losses and completely derailing your decades-long plan.
Okay, so once that foundation is set, no high interest debt, emergency fund is full, then we can start talking about investing.
Then, and only then. And that conversation has to start with the magic of compounding and the absolute power of starting early.
It's the one thing you can't get back, right? Time. We've all heard the Einstein quote about compound interest being the 8th wonder of the world.
And the Bogleheads have a great way to illustrate it. A single penny doubled every day. In just 30 days, that one penny becomes over $5.3 million.
It's exponential. It's hard for our linear brains to grasp.
It really is. And the flip side of that is the penalty for waiting. The age penalty, as they call it, is just brutal. The data in the book is designed to scare anyone under 40 into action.
Let's hear it.
Okay, let's say your goal is to have $1 million by age 65. And we'll assume a, reasonable 8% annual return.
Okay.
If you start at age 25, you need to invest a lump sum of just over $46,000. And that's it. Let it ride for 40 years, you hit your million.
46,000. That's a lot, but it feels doable.
But what if you wait? What if you don't start until you're 45? You've lost 20 years of compounding. To hit that same $1 million goal, You now need a lump sum of over $214,000.
Wow. So that's almost 5 times as much money.
Nearly 5 times the cash. Just because you gave up those first 2 decades where the money does the heaviest lifting for you, the earlier your money gets to work, the less of your own money you have to contribute.
And that's why the consistency is so important, the automatic investing.
Yes. The book shows that if you invest just $601 at the start of every month in a stock index fund, and let's say it earns 10% a year, that grows to almost $1.25 million in 30 years.
It's the habit, not the huge one-time investment.
It's the habit. And I love that the Bogleheads connect this directly to frugality. They make the point that cutting your spending is often more powerful than earning more money.
Because of taxes.
Because of taxes.
Yeah.
If you're in, say, a 30% tax bracket and you want to save an extra $100, you have to go out and earn about $143 to net that $100.
But if you just cut $100 from your budget,
you get the full $100 to invest. It's 100% efficient. And they're not talking about, living like a monk. It's simple stuff. Buy a reliable used car instead of a new one. Pack your lunch a few times a week. Make your own coffee.
that daily $4 or $5 coffee adds up.
It really does. Save just $15 a day, and that's nearly $5,500 a year. That's enough to max out a Roth IRA and let that money grow completely tax-free for the rest of your life. That small daily habit is the engine that creates millionaires.
Okay, so we built the foundation. We're keepers. We're debt-free. We have an emergency fund, and we're saving automatically. Now we have to deal with the mental side of things, the counterintuitive nature of investing.
Right. And the Bogleheads are very clear about this. They list 4 common life principles that are great in life, but will lead smart people to fail at investing.
You should go through them again because they're so important. The first one, if you don't know how to do something, hire an expert.
We're taught that from birth. But in finance, that expert often charges so much in fees that they can't consistently beat the market average anyway.
Okay, the second one, you get what you pay for.
In almost every part of life, a higher price means higher quality. In investing, it's the opposite. A high cost almost guarantees a lower return because those fees are coming directly out of your pocket.
The third one is the emotional one. If there's a crisis, take action.
Our fight or flight instinct. When the market is crashing, every fiber of your being screams, sell, get out. But acting on that panic is the single fastest way to destroy your wealth.
And the last one, the most seductive one. The best predictor of future performance is past performance.
You see this everywhere. A fund will advertise its 5-star rating or its amazing returns over the last 3 years, but the evidence is overwhelming. In investing, what happened yesterday tells you almost nothing about what will happen tomorrow.
So if those are the rules that fail, what are the rules that work?
The Bogleheads lay out 6 simple tenets. 1, choose a sound financial lifestyle. Be a keeper. 2, start early and invest regularly. 3, know what you're buying. 4, beat inflation. 5, and this is huge, keep costs and taxes low.
And 6, diversify your portfolio across stocks and bonds.
And really the heart of the whole philosophy comes down to points 5 and 6. That's what leads directly to their core strategy. Passive investing in low-cost index funds.
And this is all based on the idea that the financial markets are a zero-sum game. What does that actually mean?
Okay, so think of the entire stock market as one big closed pie. Before you account for any costs, for every single investor who wins by picking a stock that goes up, there has to be another investor on the other side of that trade who loses by selling it too soon or not owning it at all.
So as a group, all investors combined can't be better than average.
Exactly. As a group, they are the average. They earn the market's return, whatever that is. But then you have to subtract the costs.
The fees, the commissions.
All of it. And once you subtract all those costs of trying to be smarter than everyone else, the average active investor is mathematically guaranteed to underperform the market average. It becomes, as they say, a loser's game.
So the index fund is the answer because it doesn't even try to play that game.
It doesn't. It just says, I'm going to buy the whole haystack instead of looking for the needle. It guarantees you will capture the market's average return minus a tiny, tiny cost.
And the data on this is just,
Oh,
it's overwhelming.
It's relentless. Over any 10 or 15-year period, a simple index fund has at least a 70% chance of beating any given professional money manager.
And if you go longer,
If you stretch it to 20 or 30 years, the odds that an active manager can consistently beat the index approaches 0. Maybe 10% of them can do it. So why would you pay high fees for a 90% chance of underperforming?
It makes no sense when you put it like that. Now, the vehicle they recommend for this is the mutual fund. Let's just define that clearly.
A mutual fund is really just a big pool of money. Thousands of investors chip in, and a manager uses that pool to buy a diversified portfolio of, say, stocks or bonds.
And for the average person, it's really the only practical way to get that diversification.
Oh, absolutely. To build a properly diversified portfolio on your own, buying individual stocks, you'd need a huge amount of capital, and the trading costs would kill you.
So mutual funds give you instant diversification.
Instant diversification. You also get professional management. Even with an index fund, you get low minimums to start investing. And crucially, you can buy funds with no loads or commissions, especially from places like Vanguard, Fidelity, or Schwab.
Plus, they're liquid and convenient.
Very. You can get your money out in a few days, and it's easy to set up automatic purchases.
So the formula is becoming clear. Use a mutual fund as the vehicle and passive indexing as the strategy. But to really make this work, we have to dig into the enemy, costs, because that's the one thing we can 100% control.
Yes. If asset allocation is the frame of your investment house, low cost is the bedrock foundation it's built on. Jack Bogle had the perfect quote for this. He said, "The shortest route to top quartile performance is to be in the bottom quartile of expenses."
Which again just flies in the face of you get what you pay for. Why does paying more for a fund manager almost always lead to worse results?
Because every single dollar you pay in fees, commissions, and expenses is a dollar that is taken directly from your returns. It's a guaranteed loss before you even start. These costs are a drag that compounds against you just as powerfully as your returns compound for you.
So low cost is actually the best predictor of future success.
It's the most reliable one we have.
Let's break down where these costs are. The most obvious ones are the sales charges, or what they call loads.
Right. A load is just a commission paid to the broker who sold you the fund. There are a couple of types. You have front-end loads, where they take a percentage, could be 3, 4, even 5% right off the top.
So you invest $10,000, but only $9,500 actually goes to work for you.
Exactly. Then you have back-end loads, which you pay when you sell. They're often disguised as higher ongoing fees while you own the fund. The Boglehead advice here is blunt and simple. Avoid all load funds, period.
If you need advice, pay for it directly.
Pay a fee-only planner for their time. Don't pay a salesperson who has a stake in what you buy.
Okay, but the real silent killer, the cost that everyone needs to look for, is the operating expense ratio, or ER.
Yes. The expense ratio is the annual fee the fund charges to cover all its costs, management, salaries, admin, marketing, everything. It's expressed as a percentage of the assets.
And for a typical actively managed fund, what does that look like?
For an active fund, where they're doing all this research and trading, you're usually looking at an expense ratio between 1% and 2% per year.
And for a passive index fund?
Well, the manager's job there is just to have a computer track an index, like the S&P 500. So the costs are way, way lower. A good index fund should have an expense ratio well under 0.5%, and many are now under 0.1%.
Now, a 1% difference might not sound like a lot. It's 1 penny on the dollar. But the compounding effect of that 1% over decades is absolutely devastating.
The book's example on this is vital. We have to run the numbers. Let's take a single $10,000 investment held for 20 years, earning a 10% gross return each year.
Okay, so with a high-cost fund, one with a 1.5% expense ratio, what's my end balance?
After 20 years, your $10,000 grows to $49,725.
Okay, not bad. But what if I had chosen a low-cost fund with just a 0.5% expense ratio?
In that case, your end value is $60,858.
Wow, that's over $11,000 more.
It's an 18% difference in your total return just from a 1% difference in annual fees. That 11 grand didn't disappear, it just went into the fund company's pocket instead of yours. It's a guaranteed wealth transfer away from you.
And that's just the cost they tell you about in the prospectus. There are hidden costs, too.
Yes, mainly from high turnover.
So turnover is just how much trading the fund manager does, right? Selling some stocks, buying others.
Exactly. If a fund has a 100% turnover rate, it means they've replaced their entire portfolio within a year. And high turnover creates two big hidden costs. First, transaction costs, brokerage fees, bid-ask spreads, all things that are not included in that expense ratio.
And that can add up.
It can easily add another 0.5% to the real cost of owning the fund. But the second cost, especially in a taxable account, is the tax burden.
Right, tax efficiency. This is huge.
But it's massive.
Yeah.
An index fund with low turnover rarely sells anything, so it rarely generates taxable capital gains. Active funds, on the other hand, are constantly buying and selling, and every time they sell a winner, they pass that tax liability on to you, the shareholder.
Even if you haven't sold a single share of the fund yourself.
That's the crazy part, which leads to this absolutely terrifying tax bomb example from the book.
I think every investor needs to hear this story.
It's from an article by the great Jason Zweig. An investor puts $50,000 into a fund. 7 weeks later, just 7 weeks, the fund pays out a taxable short-term capital gain distribution of over $22,000.
So he's barely been in the fund, she hasn't made any money himself, but he suddenly gets hit with a tax bill on 22 grand.
Exactly. Because it was a short-term gain, it's taxed at his highest income tax rate. It cost him almost $10,000 in taxes on an investment he had barely owned.
Just because the manager was trading a lot before he even got there.
Right. An index fund, by its very nature, avoids this. They are incredibly tax efficient. This example just proves that low cost isn't just a nice to have, it's a critical defense mechanism.
Okay, so we've covered the vehicle and the costs. Now we get to what the book calls the most fundamental decision of all, asset allocation.
Jack Bogle was so clear on this. He said, how much should you own in stocks? How much should you own in bonds? How much should you own in cash? That decision is everything.
And the research backs this up, saying that this one choice, the mix of stocks and bonds, dwarfs everything else.
Completely. The famous studies on this, from Brinson, Hood, and Biebauer, and later validated by Vanguard, found that your asset allocation determines somewhere between 77 and 94% of your portfolio's returns and risk.
94%.
Yeah.
So that means picking the best fund or trying to time the market. That's less than 10% of the equation.
It's a rounding error. What really matters is the structure. The percentage you put in volatile assets like stocks versus stable assets like bonds. That is what will determine whether your portfolio holds up or gets crushed in a downturn.
Your structure matters more than your individual ingredients, which brings us to the no free lunch rule.
The fundamental law of risk and return. The greater the potential reward, the greater the risk you must accept. Stocks are risky, so they offer higher long-term returns. Bonds are safer, so they offer lower returns. Your job is to find the mix of the two that lets you capture the returns you need without taking on so much risk that you panic and sell.
Let's talk about how bonds do that. During a bull market, they feel like they're just dragging the portfolio down.
They do. They're boring. But they are your portfolio's shock absorber. That's because they have a low correlation with stocks. When the stock market is crashing, investors flee to the safety of bonds, which often causes bond prices to rise.
Do you have a good example of that?
The 2008 financial crisis is the perfect one. While the stock market was in absolute freefall, with funds down 30, 40, 50%, the Vanguard Total Bond Market Index Fund actually gained over 5% that year.
So that 5% gain from your bonds acts as a buffer against the huge losses in your stocks.
A crucial buffer. It gives you stability and prevents you from making a catastrophic emotional decision.
The book has some great historical data on this from 1926 to 2012, showing how the mix changes the risk.
Yeah, it's really telling. If you were 100% in stocks over that period, your average return was a fantastic 10%, but your single worst year was a loss of over 43%.
That would be hard to stomach.
For most people, impossible. Now, on the other end, 100% in bonds gave you a 5.5% average return, but your worst loss was only about 8%. Much safer.
But the sweet spot is in the middle.
For most, yes. A classic 60-40 portfolio, 60% stocks, 40% bonds, still returned a very strong 8.7% on average. But it cut that worst-case loss down to about minus 27%. Still painful, but survivable.
And that's how you determine your allocation. It's the sleep test.
That's the only test that matters. How much can you lose before you can't sleep at night? If you were selling in a panic in 2008 or 2020, your portfolio had too many stocks for your personal risk tolerance.
And Jack Bogle's rule of thumb.
A very simple starting point. Your age in bonds. If you're 30, maybe 30% bonds. If you're 60, 60% bonds. It's not perfect, but it's a good place to start the conversation with yourself.
Okay, so once that big picture stock bond mix is set, you also have to diversify within those categories.
Yes. Warren Buffett said, diversification is a protection against ignorance. And he's right. You don't want all your eggs in one basket.
Like the Enron employees who had their jobs and their entire retirement savings tied up in one company's stock.
A total tragedy. When the company went down, they lost everything. That's why an index fund is so brilliant. A total stock market index fund gives you a piece of thousands of companies, large, medium, and small. You're diversified across the entire U.S. economy instantly.
But you also need to diversify globally.
You do. The U.S. is only about half of the world's stock market value, so you need to own international stocks as well.
Even with the extra currency risk and political risks.
Yes, because they don't move in perfect lockstep with the U.S. market.
Yeah.
The book shows data where one year the U.S. is up 30% and international is up 20%. The next year, it could be the complete opposite.
It's that zig while others zag effect.
Exactly. You own both because you have no idea which one will perform better next year. Bogle himself was a bit cautious here, though. He suggested capping your international exposure at around 20% of your stock allocation. The goal is diversification, not chasing returns in emerging markets.
All right, so we've built the perfect logical plan. Low cost, broadly diversified, with an asset allocation we can live with. Now comes the hardest part of all. Doing nothing.
Just staying the course. This is the psychological battle. Your plan is set. Now you have to defend it from the market's noise and, more importantly, from yourself.
Because the entire strategy is built on avoiding the two biggest mistakes. Chasing past performance and trying to time the market.
Right. And the futility of forecasting is just. So the core Boglehead belief, all the academic studies show the same thing. There is no persistent skill among active fund managers. The manager who's a genius for the last 5 years is just as likely to be a dud for the next 5.
It's mostly luck.
It's luck and cost. And if the professionals can't do it, we as individual investors have absolutely no chance of timing the market.
The book mentions a study of investment newsletters that tried to do just that.
Yeah. And the conclusion was brutal. It just said, there is no evidence that newsletters can time the market. It's a fool's errand. It's pure speculation.
But the cost of trying is very real. There's that Odine and Barber study of 66,000 investors.
A landmark study. It's perfect. They found that the investors who just bought and held, with almost no trading, earned an 18.5% annual return.
Great return.
Fantastic. But the most active traders, the ones who were constantly buying and selling, their return was only 11.4%.
So they gave up 7% a year. For what?
For the thrill of trading.
Yeah.
For the feeling of being in control. That 7% difference didn't vanish. It went straight to Wall Street in the form of commissions, spreads, and taxes.
And the financial media is designed to make you do that.
It's designed for that exact purpose. The Bogleheads call it investment pornography. The hot tips, the scary headlines, it's all engineered to provoke an emotional response and get you to trade.
Which brings us to the core challenge, mastering your own emotions. Investing is this weird area where your natural instincts are almost always wrong.
Always. Greed and fear. They make us buy high when everyone is euphoric and sell low when everyone is terrified. The exact opposite of what we should be doing.
And behavioral economics gives us names for these mental traps.
It does. The book highlights 3 big ones. The first is recency bias.
Assuming what just happened will keep happening forever.
Yes. In the late 90s, people thought stocks would go up 20% a year forever, so they piled in at the top. In 2009, people thought the market would go to zero, so they sold at the bottom. They're making permanent decisions based on temporary information.
Okay, so second one is loss aversion. This one feels very primal.
It is. The research shows that the pain of a loss is twice as powerful as the pleasure of an equal gain. Losing $100 hurts twice as much as finding $100 feels good.
And how does that mess up our investing?
2 ways. We sell our winners way too early, just to lock in that little hit of pleasure from a gain. And we hold on to our losers forever, because selling would mean admitting the painful loss. We anchor to our purchase price and hope it comes back, even when it's a terrible investment.
And the last one is maybe the most common, financial negligence or procrastination.
Just being too busy earning a living to learn how to manage your money.
Which is the ultimate irony.
It is, because as we said at the beginning, every single day you're not invested is a day you lose the power of compounding. Procrastination here isn't just delaying something, it's actively costing you a fortune.
So if we know these emotional traps exist, what's the mechanical tool we can use to fight back?
The single best tool is rebalancing.
And rebalancing is not active trading. It's portfolio maintenance.
That's a great way to put it. It's just the process of bringing your portfolio back to its original target. So if you started at 60/40 and a big stock market run has pushed you to 75/25, rebalancing means you sell some stocks and buy some bonds to get back to 60/40.
And you do this for two really important reasons. The first is just risk control.
Absolutely. When your stocks have soared, your portfolio is much riskier than you originally intended. Rebalancing brings that risk level back down to the point where you can sleep at night.
But the second reason is the really clever one. It forces you to take advantage of reversion to the mean.
Which is just the idea that asset classes that have performed way above average for a while tend to perform below average later, and vice versa. And since you can't predict when that will happen, rebalancing makes you act systematically.
So when stocks have done great and are now a bigger piece of your portfolio,
Rebalancing forces you to sell them. You're automatically selling high.
and you take that money and buy the asset that's done poorly, like bonds.
You're automatically buying low. It forces you to be a contrarian, to do the exact opposite of what your emotions are screaming at you to do. It takes the emotion completely out of the equation.
It's the ultimate discipline tool. So the final piece of advice is just stay the course, write down your plan, stick to it, and tune out all the noise.
We've covered a ton of ground here, really distilled the essence of the Boglehead Guide. It's a simple, powerful framework for building wealth.
So let's just summarize the absolute key takeaways for you. You have to shift your mindset from income to net worth. Pay off all your high-interest debt immediately. That's your best guaranteed return.
And you must start early and invest regularly to harness the incredible power of compounding.
And when you invest, be ruthless about keeping costs low. That means choosing low-cost, broad market index funds. And finally, set a stock and bond asset allocation that you can stick with through thick and thin, one that lets you sleep at night.
And let's leave you with one final thought. We've talked a lot about how hard it is to predict market returns. That uncertainty also applies to retirement planning. You can use rules like the 4% withdrawal rule, but at the end of the day, it's just a guess.
And the book has this one line that just cuts through all of that, a realization that should stick with you. It says, you can borrow for college, but you can never, ever borrow for your retirement.
And that single fact just highlights the urgency of getting started and staying disciplined. The biggest risks to your financial success don't come from the market. They come from you. They come from your own emotional impulses.
The path to wealth isn't about finding the next hot stock. It's about discipline, frugality, and a deep commitment to simplicity.
That's the whole Boglehead philosophy in a nutshell.
Well, I think that's a great place to wrap it up. So thank you for watching. Please like, share, subscribe, and follow up in the next topic.
Let's continue next topic. Welcome back to the deep dive. Today we're really getting into the nuts and bolts, moving past just the theory of long-term wealth building and opening up what is basically the operating manual.
That's a great way to put it.
We're drawing our insights today from the Boglehead's Guide to Investing, that incredible collection of wisdom from Mel Lindauer, Taylor Larimore, and Michael LaBeouf.
And it really is a blueprint, isn't it? The whole power of the Boglehead way of thinking is that it completely shifts your focus. You stop trying to do the impossible, like predicting market movements.
Right, or finding the next hot stock.
Exactly. And instead, it brings your attention right back to the things you actually can control. We're talking about costs, we're talking about taxes, and maybe most importantly, your own temperament.
And that is precisely our mission for this deep dive. We are going to unpack the practical steps you need to take to go beyond just, owning an index fund.
This is the follow-through.
It is the follow-through. We're going to explore the financial readiness you need before you even invest a dollar, dig into the, really sophisticated tax strategies that keep more money in your pocket, and build that behavioral armor you need to stay the course.
Because staying the course is what separates the successful from the frustrated.
So the journey to becoming a successful Boglehead investor doesn't really start on Wall Street, does it? It starts much closer to home.
It starts in your household budget. It starts with how you fundamentally think about wealth. The Bogleheads are pretty insistent that before you pick a single fund, you have to figure out which financial lifestyle you're living.
And they break it down into three sort of distinct personas.
They do, and it's really important for you, the listener, to honestly identify where you are on this spectrum. First up, you have the borrowers.
Okay.
These are the folks whose financial lives are essentially lived backwards. They're fueled by high-interest credit cards, car loans. Their income is just permission to finance today's consumption.
They're building negative wealth.
Precisely. They're prioritizing looking good today over being secure tomorrow.
The book uses that great Texas phrase, right? Big hat, no cattle.
Yeah, that's the one. Driving the expensive car, living in the big house. But the debt holding it all up is just immense. It completely dwarfs their actual assets.
And when you look at the math behind that lifestyle, it's just brutal. It makes any conversation about investment returns totally pointless.
Let's just run the numbers they present. Imagine you're carrying an $8,000 credit card balance. The interest rate is, say, a pretty steep 18.9%.
Which is not uncommon.
Not at all. And you're just making the minimum payment, maybe $160 a month. That debt, it's not going away for nearly 8 years.
8 years?
And during that time, you'll pay over $7,000 in interest alone.
Wow. So you paid $15,000 for $8,000 worth of stuff.
You got it. I mean, think about it. If you're hoping to get an 8% return on your investments while you're paying almost 19% on your debt, you are mathematically guaranteeing your own failure. High-interest debt is the enemy of Boglehead investing.
Okay, so moving on from the borrowers, we get to the consumers. Now, these people are, a bit more responsible. They pay their bills on time. They might not have huge credit card balances.
Right, but they operate with what the book calls a paycheck mentality. Every single dollar that comes in as net income goes right back out.
So when they think about a big purchase, the question isn't, do I have the money saved up?
No, the question is, can I afford the monthly payment? And this is the group that so often misses out on huge opportunities. They don't max out their 401k match.
The free money.
The free money. Or they don't contribute to a Roth IRA just because their budget is always stretched to the absolute limit. As the book says, Madison Avenue controls their wallet. They believe they need too many things right now to save.
Which brings us to the ideal, the goal, the keepers.
Yes. And the keepers are not defined by how much they earn, but by their relentless focus on net worth.
Assets minus liabilities. Simple as that.
It's that simple. They understand that a high income does not automatically equal wealth. The keepers, they save a minimum of 10% off the top of every single paycheck, and they make it a priority to use every tax-advantaged account they can get their hands on. And this is really the crucial pivot point. It's about graduating to that net worth mentality.
Right.
Our culture trains us to ask, so what do you make as the measure of success? But income is just a flow. Wealth is what you keep. It's a stock.
You can have a huge income, but if you spend it all,
your wealth is zero. The real measure of your financial freedom is that net worth number.
So the very first practical step, the first piece of homework, is to calculate that number. You have to add up everything.
Everything. Cash, brokerage accounts, your 401k, the equity in your house, even a conservative value for your personal stuff.
And then you have to be just as rigorous subtracting all your debts. Your mortgage, student loans, car loans, and especially that high-interest credit card debt. That final number, that's your starting line.
And it is so important to see how that number changes over a lifetime. The book references a 2010 Federal Reserve survey, and the figures are pretty eye-opening. For families with a head of household under 35, the median net worth was just $9,300.
Just $9,000.
But then you look at the 75 and older group, and that median number jumps to $216,800.
What that really shows is the devastating cost of being a borrower or a consumer when you're young.
Absolutely. That low net worth isn't just a small problem, it's a failure to use your most powerful asset time. You miss out on all that early compounding, which leads to that massive gap later in life.
And on the flip side, the keepers, the ones in the top 10% of earners, had a median net worth of almost $1.2 million.
So once you have that number, your net worth, the Boglehead blueprint gives you 2 more steps before you even think about investing. Step 2 is pay off high-interest debts.
This is non-negotiable.
Non-negotiable. You have to ruthlessly attack those credit card balances, personal loans, anything with an interest rate higher than what you could reasonably expect from the market. Let's say anything above 6 or 8%.
And the sources mention that if you own a home equity loan could be a tool here.
It could be, to consolidate that debt. The interest rate's often much lower, and it might even be tax deductible. The goal is just to stop the bleeding. Stop that guaranteed loss of cash.
Okay, so that's step 2. What's the final defensive move?
Step 3, establish an emergency fund. And this money has to be completely safe and totally liquid. We're talking bank accounts, high-yield savings, money market funds, no risk.
This is your firewall.
It's your financial firewall. Life is going to throw curveballs at you. A job loss, a furnace breaking, a medical issue.
And you can't be forced to sell your long-term investments to cover it.
That's the whole point. You tap the emergency fund so you don't have to invade your compounding investment portfolio, potentially selling stocks at a huge loss just to pay a surprise vet bill.
Okay, this brings us to a really practical and I think powerful insight from the book, actually finding the money to invest. The core idea here is that frugality pays.
And it pays better than getting a raise.
That's such a huge concept. Can you break that down?
It all comes down to the tax code. Think about it this way. If you want to save an extra dollar by earning an extra dollar, you often have to earn about $1.40.
Because of taxes.
Because of income tax, payroll taxes.
Right.
That 40 cents just vanishes before you even see it. But if you save a dollar by not spending it, that is a full 100-cent tax-free dollar that is ready to be put to work.
The efficiency gap there is just massive. You're working for the government when you earn more, but you're working for yourself when you spend less.
Which leads to this wonderful concept they talk about, the $15 a day tax-free fortune.
I love this.
It's so simple. If you can find a way to reduce your daily spending by just $15, and that's pretty easy to do.
Round bagging your lunch instead of buying it.
Making that fancy coffee at home.
Right.
You do that, and you've just generated $5,475 in a year. That's more than enough to fully fund a Roth IRA contribution right now. It's capital you created out of thin air just from discipline.
And when you apply that same frugal logic to bigger ticket items, the numbers just become astronomical. Let's talk about cars.
The cost of driving. The book points out that the difference in annual cost between a new mid-priced car and a reliable 3-year-old used one is about $2,500 a year.
When you factor in depreciation, insurance, financing.
All of it. Now imagine a 19-year-old gets this concept. They choose the used car and they commit to investing that $2,500 difference every single year, earning a hypothetical 8% return.
Okay.
If they just stick with that one single habit throughout their entire working life, that savings, it compounds to an incredible $1,129,750 by age 65.
That is life-changing money from one single decision.
One habit, maintained. That is the difference between financial freedom and just getting by. It's why Jack Bogle drove a 6-year-old Volvo. It's why Warren Buffett drives an old pickup.
It's not about being cheap.
No, it's about choosing financial liberty over consumer status.
Okay, so once you've built that foundation, the debt is low, the emergency fund is in place, you're saving consistently, the next big mountain to climb is it's internal. It's your own psychology.
Yes, this is where it gets tricky. Investing has this paradox at its core. The same emotional drives that help us succeed everywhere else in life. Passion, intuition, taking quick, decisive action. Those very things are almost guaranteed to make us fail in the stock market.
It's a total reversal. We get emotional about making money, but being emotional is the fastest way to lose it.
It is, and this is why we have to lean on the field of behavioral economics, pioneered by guys like Amos Tversky and Daniel Kahneman. Their big discovery was that when people make decisions about money, they don't use pure logic.
They use shortcuts.
They use mental shortcuts, what they call judgmental heuristics. And these are often emotional rules of thumb, not rational calculations.
And those heuristics are powered by the two biggest forces in the market, greed and fear.
For centuries, those have been the two drivers. Greed makes us chase hot stocks at the peak of a bubble. It's that fear of missing out.
Aye.
And fear makes us panic during a crash and sell everything at the bottom just to stop the pain.
Selling low. The exact opposite of what you should be doing.
Both are the mortal enemy of the long-term investor.
So we need to really dig into the specific ways these emotions trip us up. The first trap they identify is recency bias.
This is a big one. It's the assumption that whatever is happening right now is just going to continue forever. If the market has returned 20% for the last 3 years, our brain just starts to project 20% returns into the future indefinitely.
Which leads to taking on way too much risk.
Way too much. The cure for recency bias is to deeply understand a fundamental market principle called reversion to the mean, or RTM.
This just means that things tend to return to their long-term average over time.
Exactly. An asset class that has wildly outperformed its historical average for a few years is statistically very likely to underperform in the future. And the reverse is true for assets that have underperformed.
You see this in those Callan charts, the periodic table of asset returns. The color block that's at the top 1 year is almost always near the bottom a few years later.
Right. The book gives the example of emerging markets. They were top performers for 11 years between 1993 and 2012, but they were near the bottom for 8 of those years. If you chase the performance, you bought high just in time for the reversion back to the average, you guaranteed your own underperformance.
Okay, what's another big trap?
Overconfidence. This is the belief that you, or some genius fund manager you're paying a lot of money to, can consistently predict what the market's going to do in the short term.
And this leads to trading too much.
It leads directly to churning your own account, which racks up transaction costs and, if it's a taxable account, generates a ton of capital gains taxes. Since all the objective data shows consistent outperformance is almost impossible, overconfidence is just a way to light your money on fire.
Then there's the psychological trap of anchoring.
Ah, yes. This is when you refuse to sell a losing stock because you are mentally anchored to the price you originally paid for it. You just keep telling yourself, I'll sell it as soon as it gets back to even.
The classic example is the investors who held onto their tech stocks after the dot-com bust, just waiting for the Nasdaq Q to get back to 5,000.
And that anchor can sink your whole portfolio. It's pure ego. It stops you from taking that money and putting it to work in something that actually has potential, all because you can't admit you made a mistake.
And I think the strongest trap of all has to be loss aversion.
It is the most powerful. Tversky and Kahneman proved that the psychological pain of losing $1 is about 2 to 2.5 times greater than the pleasure of gaining $1.
So a 20% market drop feels emotionally like a 40% or 50% loss.
Exactly. The pain is so intense that it triggers that primitive fight or flight part of your brain, and you just want to make it stop. So you sell everything at the absolute bottom. You liquidate to stop the emotional bleeding.
The Boglehead approach isn't to avoid risk entirely, because you need risk for growth.
Right. You have to be a risk manager, not a risk avoider. And you do that by setting a proper asset allocation. The bonds in your portfolio act as a shock absorber, so that when the crash comes, the emotional pain is insulated enough that you can actually stick to your plan.
Finally, we have the twin traps of inaction, paralysis by analysis, and financial negligence.
These are just two sides of the same coin. Procrastination. You're either too overwhelmed by all the information, or you tell yourself you're too busy to learn the basics.
And the result is, you either do nothing,
and miss out on the incredible power of compounding time.
or you delegate everything to an expensive salesperson who might not have your best interests at heart.
Inaction is still a decision, and it's often the most expensive one you can make.
And this whole ecosystem of emotional traps is, of course, fueled by the financial industry itself. The book calls out the great Wall Street marketing machine,
Which spends billions and billions of dollars every year to convince you of one thing, that they can beat the market.
or that you can, if you just use their tools.
Right. And you have to ask yourself why they spend all that money. It's because the stock market, before you factor in any costs, is a zero-sum game. For every winner, there has to be a loser by the exact same amount.
But once you add in costs,
The management fees, the trading commissions, the taxes, it becomes a loser's game. The group of investors as a whole is guaranteed to underperform the market itself, which is why passive indexing beats 70 to 90% of active managers over the long run.
and the media just pours gasoline on this fire, the Bogleheads have a great term for it: investment pornography.
It's designed to do one thing: excite you. They have 24 hours of airtime to fill. And let's be honest, sensible, long-term, low-cost indexing is, as the book says, as exciting as watching grass grow.
So they have to create drama.
They create drama. They make sensational predictions. They want you to do something, to take action, because that's what sells, even if that action is terrible for your long-term wealth.
This brings us to the 3 biggest lies that this whole machine tells. What's lie number 1?
Lie number 1, it's a stock picker's market.
You hear this all the time after a downturn. Oh, passive is dead, now you need an active manager.
It's a great sales pitch, but the evidence just isn't there. The Nobel laureate Eugene Fama famously compared stock pickers to astrologers. He said any success they have is just random chance that gets a good story written about it after the fact.
Okay, what's lie number 2?
The trend is your friend. This is the lie that you can forecast the market's direction, that you should follow momentum.
But short-term forecasting is basically impossible.
It's futile. It's just guesswork that's been dressed up in a fancy suit with a lot of charts.
And the third lie is maybe the most dangerous one of all. It's usually unspoken.
It's the implicit lie that past performance predicts future results. This is the engine of the entire mutual fund advertising industry.
But all the academic research, from Carhart, Barra, Vanguard, it all says the same thing.
There is no persistence in mutual fund performance. A manager who is in the top quartile for the last 5 years has no better statistical chance of being in the top quartile next year than a manager who is in the bottom quartile. It's random.
And Jack Bogle did his own study on this. He tracked 355 equity funds starting way back in 1970.
And by 1999, nearly half of them were gone. They'd either failed or been merged away. Only 169 had survived.
And out of those 169 survivors, how many actually managed to beat the S&P 500 by more than 3% a year over those 3 decades?
Two.
2 out of 355.
Two. And that's before you even think about the taxes an investor would have paid on the active funds distributions. The real number of winners might actually be 0. The odds are just so stacked against you.
So the only logical response to all this is the core Boglehead strategy.
Stay the course. If you can't predict the market, if you can't pick the winning manager, then the only winning move is not to play that game. You set a smart long-term asset allocation plan and you stick to it, period.
It reminds me of that great Warren Buffett quote, "Inactivity strikes us as intelligent behavior."
And the data backs him up. That landmark study by Odine and Barber tracked over 66,000 investors for 6 years.
And what did they find?
A huge penalty for activity. The buy and hold investors, the ones with a tiny 2% portfolio turnover, they earned 18.5% a year. The most active traders, the ones turning over their portfolio, 258% a year, they only returned 11.4%.
That's a 7.1% difference every single year.
A 7.1% annual gap. That is generational wealth that was just vaporized by costs, taxes, and bad emotional timing, all from clicking the mouse too often.
So the Boglehead action plan for your behavior is to basically make the whole process boring and automatic.
Exactly. Write down your goals. Write down your asset allocation. Set up automatic investments into your simple low-cost index funds. Keep your costs and taxes low, and just tune out all the noise. By making it a mechanical process, you build a system that protects you from your own worst emotional impulses.
Okay, so if mastering your emotions saves you from yourself, then mastering the tax code saves you from, well, the government.
That's a good way to put it. Sir John Templeton's quote is the guiding light here. For all long-term investors, there is only one objective maximum total return after taxes.
We think of expense ratios as the big cost, but taxes can be so much larger.
They are often the single biggest cost you'll face. And your first line of defense is to use tax-sheltered accounts to their absolute fullest. Think of them as a shield that lets your money compound year after year without the drag of taxes on dividends and capital gains.
Let's start with the most common one, the employer-sponsored 401k or 403b.
The benefits here are huge. First and foremost is the employer match. The book calls it free money you cannot afford to forfeit, and that's exactly what it is. It's an instant 50 or 100% return.
And then everything grows tax deferred.
Right. No taxes on the growth until you take it out in retirement. But these plans do have some serious drawbacks you need to watch out for.
Like what?
Well, 401ks can have very high, often hidden administrative fees. And sometimes the investment options are just terrible, really high-cost active funds.
And there's a big tax surprise at the end, too.
A huge one. When you finally withdraw that money decades from now, every single dollar, including all those capital gains, is taxed as ordinary income, not at the lower capital gains rate, at your highest marginal rate.
And for people with a 403b, there's a specific trap to watch for.
Yes, the dreaded high-cost annuity. Annuities are insurance products that provide tax deferral. Putting one inside a 403b, which already provides tax deferral, is completely redundant. You're just paying huge fees for a feature you're already getting for free.
Well, so that brings us to the more flexible accounts, the IRAs. Let's start with the traditional IRA.
Okay, with a traditional IRA, your contribution might be tax deductible today, which is nice. But just like a 401k, when you pull the money out in retirement, it's all taxed as ordinary income.
And you're forced to start taking it out.
You are. You have required minimum distributions, or RMDs, which force you to start withdrawing and paying taxes on that money once you hit age 73. And the penalty if you miss an RMD is massive. It's 50% of what you should have taken out.
Now, the Roth IRA is the mirror image of that. And for most younger investors, it's a much better deal.
It really is. With a Roth, you contribute with after-tax dollars, so there's no deduction today. But all of your qualified withdrawals in retirement are 100% tax-free.
And that's a huge strategic advantage if you think your tax rate will be higher in retirement than it is now.
Which it probably will be if you're a successful keeper. Plus, the Roth has no RMDs for you, the original owner. You can let that money keep compounding tax-free for your entire life and then pass it on to your heirs.
There are some other practical benefits too, right? Like you can take out your contributions if you need to.
You can. Your contributions, not the earnings, can be withdrawn at any time, tax-free and penalty-free. It adds a nice layer of flexibility. And a big one for retirees is that tax-free Roth withdrawals don't count towards your adjusted gross income, your AGI.
Why does it matter?
Because a lower AGI can mean lower Medicare premiums and less of your Social Security benefits being taxed. It's a powerful tool for managing your tax bill in retirement.
Okay, now we get to the really advanced but really powerful Boglehead strategy. Fund placement, or what's called asset location.
This is where you can add tens, even hundreds of thousands of dollars to your final net worth just by being smart about which account holds which asset.
So what's the core principle here?
The guiding rule is this. You put your least tax-efficient funds inside your tax-advantaged accounts, like your 401k and IRA. And you hold your most tax-efficient funds in your regular taxable brokerage account.
Okay, let's break that down. What makes a fund tax inefficient?
Inefficiency comes from generating a lot of taxable income each year. So this would be things like REITs, which pay non-qualified dividends, high-yield junk bond funds, and especially actively managed stock funds that have high turnover and are constantly spitting out capital gains distributions. You want to shield those inside a tax-deferred account.
And the most tax-efficient funds.
These are the ones that generate very little taxable income. Things like low-yielding cash, municipal bonds, and the king of taxable accounts, the total market stock index fund. Because it has such low turnover, it rarely passes on taxable capital gains to you.
And the difference this makes over time is not small. The book gives a great example.
A fantastic example. They compare two investors, both starting with $100,000, split between stocks and bonds over 30 years.
Okay, scenario one. The smart Boglehead puts the high-growth stocks in their taxable account and the income-producing bonds in their tax-deferred account. What's the result?
The final after-tax value is an impressive $1,005,451.
And scenario two. The investor who does it backwards, bonds in taxable, stocks in tax-deferred.
Their final after-tax value is only $886,430.
Wow. That is a difference of over $119,000.
From one single decision about where to hold your assets, you maximize your wealth by letting your highest growth assets compound with the least amount of tax friction possible.
Beyond just placement, there are other crucial tax-savvy ideas for your taxable accounts. The first is avoiding high turnover.
This is so important. High turnover is what creates those surprise tax bills. The fund manager is constantly buying and selling, realizing gains inside the fund, and by law, they have to distribute those gains to you, the shareholder.
Whether you sold a single share or not.
Exactly. Which brings us to that infamous Dr. X example from Money Magazine.
This one is a classic cautionary tale.
It is. This doctor invests $50,000 in a growth fund. Just 7 weeks later, the manager sells some big winners, and Dr. X gets a capital gains distribution for over $22,000.
And because he'd only owned the fund for a short time, it was a short-term gain.
Taxed at his ordinary income rate of nearly 40%. He got hit with the $9,000 federal tax bill, even though his actual investment hadn't really gone up in value yet. It's the silent killer of returns in a taxable account.
This feeds right into the importance of favoring long-term versus short-term gains.
It's a fundamental part of the tax code. If you hold a winning investment for more than 12 months, your profit is taxed at the much lower long-term capital gains rate, which is capped at 15% for most people. Hold it for 12 months or less, and it's taxed as ordinary income, which could be more than double that rate.
So buy and hold isn't just a behavioral strategy. It's a huge tax-saving strategy.
That is massive tax shelter.
Okay, what about the technique of tax loss harvesting?
This is a more advanced move, but it's very powerful. It means you intentionally sell investments in your taxable account that have lost value. You harvest that capital loss.
And you could use that loss to cancel out gains elsewhere.
Exactly. You can use it to offset capital gains from other investments, which reduces your overall tax bill for the year. Studies have shown this can add a huge amount of value to a portfolio over time.
But there's a big catch, right? The wash sale rule.
A very important catch. The IRS says you can't claim that capital loss if you buy back a substantially identical security within 30 days before or after the sale. So if you sell an S&P 500 index fund to get the loss, you have to wait 31 days to buy that exact fund again.
Or you could immediately buy something similar but not identical, like a total stock market index fund.
That's the pro move. You stay invested in the market but still get to book the loss for tax purposes. It's a crucial detail.
Lastly, let's just touch on municipal bonds, or munis. Who are these for?
Munis are for investors in the higher tax bracket, say the 25% federal bracket or above, who have already maxed out all their tax-deferred accounts. Their big advantage is that the interest they pay is generally exempt from federal income tax.
And you have to do a little math to see if they make sense for you.
You do. It's called the tax equivalent yield. You take the muni bonds yield, say 5.75%, and you divide it by 1 minus your federal tax rate. So if you're in the 28% bracket, you divide by 0.72.
And that tells you what a taxable bond would have to yield to be equivalent.
Exactly. In that case, the tax equivalent yield is almost 8%. So if you can't find a comparable taxable bond yielding 8%, the muni is the better choice for your taxable account.
Okay, we have laid all the groundwork, the intellectual, the behavioral, the tax strategy. Now we get to the ongoing maintenance, the mechanical follow-through that keeps you on track for decades.
And this is where the Boglehead method provides that structure you need to get through volatile times. It all comes back to the cornerstone: asset allocation.
Bogle said it was the most important decision an investor makes.
And the research backs him up completely. Those famous studies by Brinson, Hood, Biebauer, and later by Vanguard showed that your strategic split between stocks and bonds determines somewhere between 77% and 94% of your portfolio's returns and volatility.
It's not about which stock you pick.
It's not about picking stocks. It's not about timing the market. It is all about the allocation.
And when you're setting that allocation, the role of bonds is so much more than just returns. They're an emotional stabilizer.
They are your insurance against panic. Just look at 2008. The stock market cratered, down 37%, but the Vanguard Total Bond Market Index Fund was actually up over 5%.
It's the ballast for the portfolio.
It is. The book shows how a 100% stock portfolio had a worst-case annual loss of over 43%. But if you just move to a simple 60-40 mix, that worst-case loss drops all the way down to about 26%. That bond buffer is what allows you to ride out the storm.
And for new investors who haven't lived through a really nasty bear market yet.
Well, the Bogleheads have very specific advice. Start with 10% to 20% more in bonds than you think you need. That extra cushion is insurance against your own future panic. It's what will stop you from selling at the bottom.
Okay, so the allocation is set. The next job is tracking the portfolio.
You have to know where you stand. You need to periodically check your actual holdings against your target. You can use free tools from your brokerage or from a site like Morningstar to see how your, say, 60-40 mix has drifted.
And how often should you be checking?
This really depends on your personality. If you're a skittish investor, maybe you only look at your statements once a year, in December. You want to minimize your exposure to the day-to-day noise that could make you do something foolish.
But for an educated, disciplined investor, checking more often can actually be a good thing.
It can be a learning experience. If you check quarterly, you're not doing it to make a decision. You're doing it to observe how your different asset classes are behaving, to really see diversification at work.
And that tracking naturally leads to the next step, rebalancing.
This is the mechanical process of bringing your portfolio back to its original target allocation.
And there are two big reasons this is so important. The first is risk control.
Absolutely. If you have a few great years in the stock market, your 60% stock allocation could easily drift up to 70% or 75%. You're now taking on way more risk than you originally intended. Rebalancing forces you to dial that risk back down to your comfort level.
And the second reason is return enhancement.
This is where rebalancing becomes this brilliant automatic way to sell high and buy low. It's the practical application of reversion to the mean. You are mechanically forced to sell some of the asset class that has done well and is now overweight.
Selling high.
And use that money to buy more of the asset class that has done poorly and is now underweight.
Buying low. Setting yourself up for its eventual rebound.
You're doing the smartest thing in investing without having to use any emotion or guesswork at all.
So, when to rebalance? What are the methods?
There are two main disciplined approaches. The simplest is a strict time interval. You just do it once a year, maybe on your birthday or on January 1st. It's simple and it works.
The other method is using expansion bands.
Right. You only rebalance when an asset class deviates from its target by a certain percentage, say 5%. A more advanced version of this, which the Bogleheads like, is to use a percentage of the original allocation as your trigger.
How does that work?
So if your target for stocks is 60%, you might rebalance when it deviates by 25% of that 60%. So 25% of 60 is 15 percentage points. You would rebalance if stocks hit 75% on the high side or drop to 45% on the low side. It avoids overtrading on small moves.
And finally, the really critical part. How to rebalance efficiently. with taxes in mind.
The number one rule is, if you can possibly avoid it, do not sell shares in your taxable account to rebalance. That creates a taxable event.
You realize a capital gain and you have to pay tax on it.
Right. So you want to use other methods first. The best way is to use your new contributions. If your stocks are overweight, you direct all your new savings into your underweight bond funds until you get back in balance.
You're rebalancing with fresh cash.
Exactly. The second best way is to have all your dividends and distributions automatically reinvested into whichever asset class is currently underweight. Both of these methods let you rebalance without triggering any taxes.
And if all of this mechanical work sounds like too much of a hassle,
there's a simple, elegant solution: a target retirement fund. It does everything for you. It automatically rebalances internally, and it automatically becomes more conservative, adding more bonds as you get closer to your retirement date. It's the ultimate set-it-and-forget-it Boglehead solution.
So that really brings us to the end of the blueprint. We started with that foundational need to adopt a net worth mentality, to see that frugality is actually a tax-advantaged strategy.
Remembering that just avoiding a new car can generate over $1 million.
Then we hammered home the absolute need for behavioral defense, identifying those emotional traps like recency bias and anchoring.
And committing to that stay-the-course philosophy, which is backed by all that data showing that active trading is just a losing game for almost everyone.
We did a deep dive on tax efficiency, how to use tax-advantaged accounts, and crucially, how proper asset location, hiding your tax-inefficient funds in those accounts, can make a six-figure difference to your final outcome.
And finally, we covered that critical follow-through, setting your strategic allocation with enough bonds to act as behavioral insurance and then mechanically rebalancing with new money to enforce that sell high, buy low discipline.
Let's close with one final reminder of the incredible, almost magical power of time and compounding. Let's go back to that 25-year-old who starts putting $4,000 a year into a Roth IRA.
And they get an 8% average return. By the time they turn 65, that portfolio is worth over $1.1 million, all tax-free.
Now, what happens if that same person just waits 10 years? They start at age 35, same amount, same return.
The result is devastating. Their portfolio at age 65 is only $489,383.
They invested for 10 fewer years, and it cost them over $600,000.
It costs them $620,000. Time is the one asset you can never, ever buy back. It is your single greatest leverage.
So considering that immense power of compounding and the proven futility of market timing, what single investment habit, consistent, systematic saving, or just tuning out all the noise will you commit to today to secure your own financial freedom?
Thank you for watching. Oh, do not forget, share, subscribe, follow up in next video.